This is All Star Alligator. I'm your host, Austin Jia. Today, I'm joined by Bill Woodruff from Wealth Factor. He has an incredible career in finance, building a hedge fund and sold it to Fortress. And then he started his own wealth management company and quickly scaled to over $100 million asset under management. We talked about his playbook on building a business, AI infrastructure investment, and how to invest and grow in uncertain market environment. I can't wait to get started. Let's jump in. Hey, Bill, welcome to the show. So you have an incredibly successful career, right? You founded your own business. You worked as a senior management at large financial institutions. There's really a lot to talk about. But in your own words, can you tell us your story for our audience?
Sure. First of all, I really appreciate the opportunity, and it's nice to be here. So, I have been focused largely in the investment industry for approaching 25 years. I oftentimes describe my background as starting out building trading systems for a hedge fund. Very lucky. Couldn't really have drawn it up better. Being able to cut my teeth in one of the more complex areas of publicly traded global financial markets was wonderful. That firm that I was working for launched a fund of hedge funds, and so I was able to do manager research and due diligence with a hedge fund focus and orientation. One of the funds that we ended up investing in had a strategy that could be replicated in a liquid format, and I was tasked, given my trading systems background, to design how to do that, which led to the creation of an early industry liquid alternative in a separate account format. The firm I work for had some strategic and directional issues and challenges, which I ended up turning into an opportunity. I left that organization to start my first investment business. I technically formed that in late 2007, but I started taking clients at the beginning of 2008. That was called Bandon Capital Management. In 2011, made the decision to launch a mutual fund, leveraging those, I guess what you would call hedge fund investment techniques. That fund business was acquired by a subsidiary of Fortress Investment Group in 2014, and I went to work for Fortress, spending a fair amount of time with them, helping to, one, transition the mutual fund business they acquired from me, and then also exploring ways in which they might grow into liquid alternatives. My time with Fortress went down in early 2016. That led me to starting a Wealth Factor in 2017, really with the mission of trying to disintermediate as much of investment related services as I could. Then was faced with the question of how do I get clients? Because I wasn't super interested in growing a practice, wanted to explore different paths. I also was interested in finding a way to grow in repeatable and more systematic ways. And that led me down two paths. One ended up being automations that are sales and marketing oriented. The other part that I focused on next was the creation of a proprietary portal to help take, say, somebody who had received marketing and or sales communication, allow them to create a user and take those next steps in the process.
There's a lot to unpack. Actually, it's very interesting. There's one nugget that I noticed from your past when I was doing research was your first job was to cold call people to buy stocks. And one of the stocks is McDonald's. Needless to say, people who bought McDonald's back then probably made a lot of money, but that was wild, right? Like it's something that not many people in the finance industry had such experience today. So did you have to make a lot of phone calls? Like, did that teach you the importance of the system later on? Like, what lesson did you learn from that practice?
Yeah, it was clearly meaningful to me because I consider myself to have a very poor memory generally, but I still remember doing that. I still remember. I mean, I can't say, recite any of the script that they provided, but I can still recall talking about both McDonald's stock and Home Depot specifically. But yes, an incredible number of calls, very structured and systematic and script oriented. And it didn't take very many months for me to recognize that this isn't exactly what I had envisioned investment related activities being, dialing for dollars, if you will. But it was certainly very valuable because it really helped me start to put together an understanding of the end customer's psychology when it comes to investments. For me, that's an important consideration that doesn't always develop in many investment professionals. And so I valued that time.
Yeah. One thing I've noticed as my experience is when I was working at the institutional finance world, a lot of things, the assumptions that we took for granted, but that was not the direct experience from consumers. And you have to have the layer, like that direct touch with consumers to understand, like, oh, this actually resonate with the market. So I think for me, I'm on this journey still. And yeah, it's my McDonald moment. My observation is like you launched Abandon, and you said it's a great time, but it is just during the financial crisis, right? And the financial news was probably pretty negative when you were trying to do that. And at the beginning, you didn't have much to lose per se. Why did you decide to start a business during that time, and what kept you going?
Yeah, the decision to start Bandon wasn't necessarily just let me draw this up and let's do this. It was more of a okay, there are structural issues with my employer. This isn't going to work in its current format. Let's go to the drawing board and try to solve for that. And it just so happened to be right before the financial crisis, more or less. And so I think, as I reflect back on my time, I uh, have a very high tolerance for business risk. And I think that's what makes being an entrepreneur and starting and building businesses myself a strong fit. I know a lot of people, my wife included, that have a very low tolerance for business oriented risks or risks in general. And as the headlines started to develop, which I was well into it by September of '08 or around when it became clear that this isn't just your run of the mill year. I was pretty in and heads down in what I was doing. The investment strategy that I ran was interest rate anticipation strategy that was built at that time solely on treasuries. Treasuries made money in '08, and the strategy that I ran happened to also make money in '08. And so that certainly made it a little bit easier to be to have making clients money in 2008 in my first full year in business. Certainly took the edge off things. It was interesting though, just because I was making money didn't mean that I was growing or getting new clients or existing clients weren't redeeming because of the crisis being liquidity in nature. So if they had issues in their other parts of the portfolio I wasn't responsible for, I might have still lost client assets.
Yeah, generally, it was a time that people needed liquidity, and you actually happen to have such a liquidity. Therefore, inevitably, there's some fluctuation. But how fast did the capital start to flow back to you when the panicking stops, or what was the signal that you were able to see, like this is turning back up again?
Yeah, I mean, fortunately, those that redeemed, it wasn't necessarily hugely impactful, and it was just noted though, especially given how well we were doing relative to others. But yeah, as the, I guess, general freezing of activity thawed, we saw that benefit us, and we saw our assets kind of go back in that growth oriented path, and just time and time again that's the case where whether it was COVID or the recent tariff situation, it's investors pause and wait till the dust settles before they start to do new activity. And so the financial crisis was more or less the same thing.
And you said due to the success of the business, actually were able to sell that business to Fortress, which is a huge accomplishment in the finance world, and especially when you made the MD title, that's also a long-term position many people settle for life. What did you do then, and what was the reason that you actually didn't do that for more than a decade?
Sure. So the first of all, the Bandon at peak was around 10 people on our team, and so I can't take credit for all of the success and especially the lead up and growth that as well as the identification of the conversation that ultimately led to a transaction with them. So it was very much a team effort. In regards to my role at Fortress and my winding down of that activity, I don't think I really could have communicated this back then, but now with approaching again 25 years of professional experience, but more specifically, the vast majority of that operating as an entrepreneur, going into a Fortress and having different business lines compete against me and having to try to figure out how to align with teams that had, I couldn't control their focus. There was just a lot of intra-company aspects that just weren't of interest to me. I didn't want to spend my time that way, and I guess also at the core, building enterprise value for somebody else just isn't me.
Yeah, that makes sense. Working at a big company, there's a lot of things to balance. They are incredibly productive as a whole, but individually, it adds additional layers. And so you left the Fortress and you started a new business called Wealth Factor, right? And I noticed that Wealth Factor focused on the things that, as you mentioned, is try to be simple, accessible, and transparent. I, if I may, this is many people's spiel. A lot of people say we wanted to make things super efficient, and yet we're still living in a world that is not so efficient. How do you operationalize this philosophy when you are doing the day-to-day investment and company management?
Yeah, that's a great question. And I can't pretend that I solved all those puzzles in a way that could scale. So I think about a distinction in when one is providing an investment related services to individuals as being delivered through a practice format versus a scalable business format. And I spent a lot of iterative time on identifying ways to have it be a scalable business format. There's a lot of time, energy, attention going into softwares and proprietary portals that help bridge those different groups and gaps. Uh, Taking and creating automations for the purposes of lead to prospect conversion and prospect nurturing creates more scalability and repeatability in the client acquisition process, building trading systems that allow for the construction and ongoing management of a portfolio to allow for both personalization, but also to remove the need for an external asset manager or investment manager to be hired. That increases transparency. I believe reducing layers of outside intermediary parts increases the simplicity.
So it's a tech driven business that like the technology piece help you automate and simplify a lot of processes. How important do you think you need to sit down with the customer when you first meet them and convert them?
Yeah, I think it's very important. And when I started and set out, it wasn't the goal, the stated goal or the goal in my mind, if you will, was to try to build a business that wasn't built around that, because that's not scalable. But in my practical reality, yes, that ingredient or element is required in selling an investment related service to individuals. You're selling a relationship of trust. And the best way to build trust is through direct in-person experiences. I believe that the number of those connections can be reduced through intelligent design of automations and communications that are being delivered in addition to in-person and direct communication. But I still believe that part is important, and to some degree the best way to win new business and maintain that. Also, when it comes to, as wealth becomes more complex, which generally happens as it grows, there's value that one can provide is tends to be less investment specific and more tailoring a holistic solution to an individual or their household's situation. And that requires more thought, more time, and a better understanding of the uniquenesses of each household, which is best done with in-person and direct conversation.
That makes sense. And if you have to say like 50% as using 50% as a hurdle, how many Is it above or below 50% of the clients that you have met in person?
Well, a lot of the growth that I experienced happened after 2020, and so the pandemic had a pretty major influence on that. They chose not to meet in person given the pandemic. They still prioritized proximity to the office and they wanted somebody close by that if they could come see if they wanted to. And over time I've tried to encourage those clients to come actually see me, but not all of them have. And so the pandemic changed a lot of that and the broad and general ability to rely on a virtual meeting. So I still advocate and suggest to all that are seriously considering working with Wealth Factor that they spend time in person. The detail and the nuances that come out of those sorts of conversations tend to be higher, and to the extent that that's present, the tailored solutions are going to be better overall.
That makes sense. And you were pretty humble about your success. You actually scaled your business to more than $100 million for a couple of years. That journey for many people would take a decade or two. I think you are a guy on playbooks. You prioritize scalability. You like playbooks, and you published a lot of investment playbooks on your website. For those who are interested, you should check it out. But what's your playbook about growing your own business? Is technology the thing? Can you give us a more concrete example of that?
Yeah. So from a playbook perspective, for me, there's a couple different ingredients. Technology certainly plays a large role, but having a process and a set of systems around that process to where you try something, you identify what works, do more of that, and identify what doesn't work, and consistently go through a process where you're refining. You have to see how they respond and you have to consistently adapt to that so that you're being as efficient as you can with your time in winning customers. And so, and I mean, that's something that's been a learned skill for me, but that's, to me, that's the playbook. It's simultaneously standing up the resources and systems and processes that you need to deliver the services that you're going to deliver, and then going out and getting in front of enough leads and prospects so that you can develop a narrative that is one where they understand at the end of that conversation how they might benefit by employing your services.
For entrepreneurs, right? Sometimes when you run into a wall, it requires persistence, and you need to keep doing the thing until you have developed some sort of things. Sometimes you just have to change it quickly. You are looking for to be nimble.
Yeah, that's a really hard one. Because it's subtle and it's nuanced, and it's a lot of times requires sort of a mosaic of data points to draw conclusions around what's working and what's not working. And that's really a there. And then there's an ingredient of being very comfortable with the risks of it not working, because you have to be in that moment long enough to get good data. There's in identifying signals or information that's useful to direct your strategic focus on a business. Those signals are not quick fixes. They're not, this one little moment. It really is collecting an aggregate amount of data points through just putting your shoulder behind something and going out and getting a high volume of that activity. And then again, I think the best way I would describe that is taking a kind of the mosaic of all those data points and making the best strategic pivot that you can at that time, and not looking back and doing it again and iterating and refining and removing what didn't work and doing more of what did work.
Yeah, sounds like that there's a lot of art and judgment calls in that. I mean, maybe that's the art of being a successful entrepreneur, to know where to push and where to give in. And so, regarding your next focus, which is AI infrastructure partners, I think it's super interesting. I personally believe this will change how we do a lot of business in the next 10 years or even longer. Maybe tell us more about your focus there and what's your thesis.
Yeah. So from a thesis perspective, first let me define AI infrastructure, because by putting AI at the front, it's very people gravitate to AI and that part. But as I think about and evaluate the opportunities on the infrastructure side specifically, that can take multiple shapes. But first of all, if we talk about, or if we define AI as a software that's pursuing super intelligence or artificial general intelligence at the highest level. And then below that, there's this massive amount of infrastructure that's still software in order to pursue and realize that. And there's probably some software infrastructure below that. Then below that, and I think about this sort of as a pyramid visual, those things are then predicated on hardware in some way. And I would break hardware or the physical world into three categories: the chips that are needed to power the compute. What I prefer to call is AI factories, but that's another way of defining a data center. And I prefer AI factory because they really are factories of intelligence now. They're not just a center that's housing data anymore. And so AI factory would be the second category. And then the third would be power systems. And so that's how I would frame out AI and AI's infrastructure at the highest level. Then from a investor perspective, how do you go out and deploy financial resources in hopes of benefiting from these trends? For me, the race for super intelligence and general artificial intelligence is very capital intensive, and the leaders are, way ahead, highly valued. And so having exposure to that to some degree, it's hard not to, right? If you own uh, anything that's S&P 500 related, there's a very concentrated exposure into that category. But to me, I don't look at that as that part of all of this as the highest risk adjusted return potential. Then there's that whole, well, I guess what you define as the hyperscalers massively in CapEx into AI factories and into chips in order to fuel their race or their growth. And so that's the investment that I think it has where there starts to become greater opportunities as a risk adjusted investor. And I'm going to omit power systems for now. There's a lot of opportunity there, but I'm going to keep the focus on factory and chip manufacturing. And so with AI factories, there's a lot of attention to that, yeah, and a lot of investment, and it's competitive. There's a lot. I mean, there's still opportunities to go on and win in that space, but the problems are being solved, and there's a lot of resources and a lot of large scale organizations pursuing that. The chip manufacturing side is where and I guess semiconductor industry and its sub ecosystem is where AI Infrastructure Partners is primarily focused in the short run. And the reason for that is there are a variety of reasons for that, but in short, it's my belief that there's the most fragmentation and the biggest opportunity to provide value. So in that space, we have as a nation offshored the hardware technology leadership, the industrial and manufacturing required for hardware for 4 to 5 decades. And for lots of reasons, revitalizing and securing supply chains, advanced chips, and onshoring industrial and manufacturing capabilities in the United States, I think is a national security imperative. And today, there's one path really to do that, and that's Intel. However, Intel, for lots of reasons, the effects of offshoring, is in a strained spot to deliver on hardware technology leadership on the chip manufacturing side. And so AI Infrastructure Partners is aligning capital for the purposes of solving through a platform, an acquisition-based corporate platform that will vertically integrate this incredibly fragmented ecosystem in the pursuit of maximizing the potential that the United States specifically can not just to shore up some of the challenges, but inevitably kind of restore our potential as being a hardware technology leader globally.
As you said, the AI investment is super capital intensive, usually concentrated among the biggest players. How big of the fund are you trying to build, and how big of the scale are you playing?
Yeah, it's very large, especially relative to the oftentimes what software as a service that whole industry gets funded with initially. So we're targeting a total capitalization of 6 billion and looking to do a 1-to-1 equity and debt on that raise. It's not going to go from where we are now to 6 billion. So we're currently in the process of raising a first tranche, which is 100 million of equity.
Makes sense. And I personally also believe that AI infrastructure is much needed in the US, and we actually have one of the investment catalysts as data center for our investment in Columbus, Ohio for housing, because we believe it will bring a lot of other industries and people into that region. If you look across, and for my benefits, across different metros, what are the hot spots for real estate that would be beneficiary of the AI boom?
Yeah, a lot of activity in the Phoenix area. The entire state of Texas, upstate New York has a fair amount, and then largely because of Intel's presence, the state of Oregon. But you know, in those universes that I mentioned, Oregon's been the least as a state supportive of these sorts of activities. So because of how capital intensive it is. It does states who are being aggressive in supporting this activity are seem to be out in front.
Hmm. Yeah. And for smaller investors, individual investors and family offices who wants to be part of the AI boom, what advantage do they have? And how do they participate without massive capital commitments?
It's really not easy. I think the average individual, high net worth, and even family office is more likely to get into and allocated to a hyped AI startup, venture-backed startup, than they are where the risk asymmetries are probably negative, overpaying for hype relative to a probability of future returns and earnings commensurate with the valuations paid. I think it's really difficult. In contrast, we're buying businesses that are profitable already and believe that we can unlock substantial upside by solving real problems that exist in the chip manufacturing sub ecosystem.
So, looking back, a couple of things on the investment. So, is there anything that you think you made the right call at the right time and you're super proud of? And AI being one of those in the future, but what was the investment you were proud of back then?
Yeah, I don't whether it's winners or losers, I have a very short memory, and I think that's probably a entrepreneurial requirement because,
Yeah.
failing often and learning and just sort of embracing it is required. I mean, there's lots of things that have not gone in a straight line for me. I think the way I would respond to that is really one of being a part of major macro industry trends or shifts early on. And so, I started in building a one of the earliest liquid alternative separate account strategies in around 2005. It might have been 2006. And so I was very early into that space, and it was and being an early mover into that space led to being in a spot where a public company acquired a business line from that. And then I think the same thing's true with AI infrastructure partners, where very early stage, we identified that there was a very high probability that this massive amount of capex was going to go into this space, really regardless of whether superintelligence and artificial general intelligence would come to fruition and whether these companies could really turn that into a business model. And so, I think about allocating capital from a risk perspective, going to an area where there's massive amounts of money and tailwind and a business positioning that will really benefit regardless of whether the end aspects monetize in the short term. And so the example I would share there is with the late 90s tech boom and then the ultimate bust. I mean, that was based on the internet's potential, and the internet became and all businesses associated became massively valuable and drove the last 25 years of value creation largely. But if you were just investing in the hype names in the late 90s, you probably didn't end up making a lot of money through that process. And I'm not suggesting that I have any idea whether that same thing's going to repeat with AI from a software perspective, but I feel much more comfortable building a business that's going to profit from the capital expenditures of hyperscalers and will benefit as long as the United States is pursuing a strategy to re-onshore its industrial and manufacturing capabilities.
Yeah, that play with the trend and find the value within the trend. That makes sense. So, for new capital allocators that are building a career today, what advice would you give them?
Sure. I think that it has been too easy for too long to identify and participate in what did well yesterday and do more of that. In my longer term observations and then aggregate research, I think that applying a more critical lens to how one allocates risks, and rather than letting the influence of what did well yesterday, NVIDIA as an easy example, and applying a more critical lens to future looking resilience relative to value, resiliency in the earnings creation potential is how I would suggest allocators be very, I would suggest allocators be very cautious of just getting comfortable with what's been working.
Yep, sounds good. Yeah. So, I'm going to turn to a few lightning questions, and anything that comes to your mind would be helpful. So, what do you do outside work?
I run, I read, I listen to podcasts while I run. I have 3 boys. They're all playing football right now, so that outside of work, that's about all I have time for.
Sounds great. And by the way, for the listeners, he took the second place in Portland Marathon, and he's a serious runner. Yeah. And so, what is the book that you like the most and had a big impact on you?
Sure. Well, like the most and had impact, those are 2 very different questions, but I'm going to choose the bigger impact. So, Fooled by Randomness is the book that probably shaped how I think about allocating and investing and sort of business decisions. I'm very skeptical about trends and very skeptical about what appears to be easy, and so I highly recommend that book for everyone. And I think it's especially important today and ties back to my last comment about newer allocators questioning very critically the things that have been working and just doing more of that.
Yeah. And one skill that you wish yourself could master earlier.
Understanding the psychologies of who I'm selling to. It took me a very long time and a lot of work to get to understand and perceive who I'm talking to and how they think, and allow that to influence the way in which I shape my narrative and the direction of our conversation. That was very much a learned skill for me.
Interesting. And what's a contrarian belief that you think about the market that other people don't generally agree?
Well, there's definitely pockets of different types of investors. And this view I'm going to share is one that there are plenty of people that agree with this, but I don't know that it's mainstream. For me, owning cryptocurrency assets directly is, I think, a very bad idea. I think about, say, Bitcoin as an example, as leveraged hype. It's not to say that it's not useful, but I think what it represents as a tradable asset is all of the types of assets that are high valued, I think it's represents that plus extra leverage or concentration in that. And so, and we've seen that in, I mean, I haven't actually studied this from a data perspective, but just observationally, when hyped assets or high valued tech and innovation oriented assets sell off, crypto sells off in lockstep with that and typically to a greater magnitude. And so that's my contrarian belief.
Yep. Now it's getting mainstream. So, but I personally, I don't have much allocation in crypto either. And what lesson do you want your kids to learn about money?
Gosh, the hardest one is the idea that they, through investing or not spending and deferring, there's that's going to create financial resilience, both psychologically and then on a personal balance sheet basis. Being a saver is under appreciated in our current economy, and I hope that my conservativeness there will rub off on them at some point.
Sounds great. And what's the one habit you have that keeps you sharp every day?
Every day that I run and I have an opportunity to let my mind drift, not unlike prayer or meditation. And when I get into that state, it's phenomenally productive. Some of my best solutions come while running and allowing for that period of creative problem solving to really kick in.
Awesome. And where can people find you?
I have two websites, wealthfactor.ai and AI partners.ai. Both of those have contact information.
Sounds great. Thank you so much for spending the time with us. I really appreciate it. I learned a lot, and you've been building a successful career, and I'm sure this trend will continue.
I appreciate your time and thanks for the great questions.
Thank you. That's a wrap for today's episode of All Star Allocator. Big thanks to Bill for sharing his perspective. If you enjoyed the conversation, make sure to follow the show wherever you listen to your podcasts. And if you're finding value, quick rating or sharing with your friends goes a long way. Thanks for tuning in, and we'll see you on the next one.